Hi, this is Skyler Weinand with Regan Capital. We're pleased to present part 3 in a series that talks about positioning a portfolio for potentially higher interest rates and a steepening of the yield curve. Here, we'll review the underwriting of floating rate non-agency bonds. So this is first of all, I'll show you what we'll look at in Excel, where we would normally be bidding on this bond. Usually we would have 150 line items in the spreadsheet that we're bidding on daily. We'll split that up amongst me, Arup, and Adam. I'm primarily focusing on anything over $1 million. Arup's looking at 100,000 to $1 million. Adam's looking at smaller pieces. But in here's the bond name. We're dropping in the bond name and we're dropping in the original face, which is 62 million is what this was at origination. Currently, it's at a little over 21 million current face. We own that size. It's currently marked at 52.8. I think our average purchase price recently is about 51. We identify whether or not it's modeled by NAIC. It says here it's modeled. We identify if this has any COVID-related delinquencies, i.e., are delinquencies possibly not reported in what Bloomberg and Intex report. Proceeds over here, this is about what we own, about 11 million invested across our funds. So it's about I think about a 2.5% position in our main fund. I'll just look at here. We'll go over a little bit more detail of the structure here, but we're looking at 14% delinquent. Average loan size is $254,000. Loan count, that's what LC stands for, is 888. There's a lot of loans in this deal. We do look at pricing sources. So Bloomberg doesn't price this. IDC has this priced at 53.64. So if we own this in our mutual fund, it would get priced at 53.64. It's paying a measly coupon of 0.34. Is it wrapped? Is it rated? It's rated C by Moody's. It's option arms. It's a floating rate security. Here's what it paid last month, about 1.3 million in principal, 77K in interest. So now I'll flip over to Bloomberg, just at what we would look at, or if we didn't have more sophisticated models and you just wanted to look at Bloomberg. And a lot of what we pull in Excel is Bloomberg, is Intex information, is our proprietary database information, some exterior research that we're looking at. But that's a lot of what is just pulled into Excel. But for layman's purposes, we can look at a couple of things in Bloomberg here. Your coupon is paying LIBOR plus 19. We can look at some stratifications. This deal's 81% owner occupied, 64% single family homes, 19% townhomes. 57% of this deal has never been modified. 84% is current. They're current on their mortgages. This is the breakdown between borrowers that are paying a fixed coupon and that are paying 12-month MTA plus a margin. LTV, this is important, obviously. Weighted average LTV is at 54%. These borrowers have 45% plus equity in their home. That's your weighted average. Your standard average is only 51. So it's kind of weighted down here by these some of our larger loans. Current loan size, a very healthy $400,000 current loan size. Those types of borrowers are more likely to prepay. And when they do default, you get better recoveries on them. Credit score is about 701. So I'll stop there on this screen and quickly just go to collateral performance. 888 loans. The borrowers are paying 396. Weighted average loan age of 165. These borrowers are almost about 14 years old. And then last thing I'll just comment here is the percentage of loans that have been making 24 out of 24 payments. So 27% or 73% of your pool hasn't missed a payment in 2 years. 61% of your pool hasn't missed a payment in 5 years. And if you really wanted to get down to the nitty gritty, if this were, we get asked a lot, well, are you looking at loans? What are you doing? You can look at, if we wanted to look at the really bad loans, the real estate owned loans, and this is about 2.3% of the pool, you can get data on every single loan. This is your payment history. This guy's been basically in foreclosure for a very long time. Loan sizes, you can get down to what coupon are they paying? What payment are they paying? What's their credit score? What is their HPI updated LTV, inclusive of pay downs plus home price appreciation? So you can get down to nitty gritty. If you really wanted to, you could get that borrower's address But over here, you're like, all right, it's in New York. It's a purchase property. Okay. So let me get out of Bloomberg and let me pull up one of the databases that we subscribe to here, which is Webb's Hill, where it's going to give us a little bit more detail on the loan. You can see here that Bloomberg is reporting that 82.5% of these mortgages are current. But in reality, we subscribe to this service that gives us the nitty gritty of like what's actually current. Let's really drill down to what's happened since COVID, what's current. And COVID adjusted about, there's a discrepancy here of about 8%. 75% of this pool is delinquent, okay? So I'll pop up Intex here. Intex is really the gold standard for how we analyze these deals. And this is my main page on Intex. There's $225 million in collateral, i.e. loans, collateralizing these three bonds. And we own the A1C bond here, okay? So that collateral is collateralizing 357 million. If you take 225 and you divide it into 357, it's a balance of about 63 cents. So you can, we bought this at 51, you can get 63 back plus coupon, okay? So 51 divided by 63 is roughly 81 cents. So we bought this deal at 81 cents on the dollar and we get our coupon back. Collateral, this page, it's probably hard to see this, but what we're primarily looking at here is what is it's paying? It's paying down here roughly, you know, this is CPR. So last month it paid 8.5% annualized, i.e. 8.5% of the borrowers prepaid their mortgage. But if you look at where trends are going, you know, you can see here that it's more like 12, 13, 14%. And these borrowers, they're ripe to refinance. These borrowers are paying a 4% coupon. They have a lot of equity in their homes. There's a lot of California borrowers in there. Housing is going crazy in California. So what we use Intex really for is to model these deals and to look at historical payments, okay? So here you're looking at 13, 14% annualized prepayments, annualized defaults in the range of 2 to 4. And when they do default on average, the severity is only about 43%. So you get about 57% of your money back if a borrower defaults. So you owning this bond at 51 cents on the dollar, you actually really don't care if they prepay or default, given that you get that much money back on recovery. But on a go-forward basis, as these borrowers attain equity in home appreciation, they should be refinancing at a higher rate and their recoveries will be better. So we'll go over to actually running the bond here and looking at different scenario analyses. So in our base case scenario, we're going to run it at 10 CPR, 3 CDR, 45 severity. That's 10% prepayment rate, 3% default rate, a 45% recovery, basically your 12-month averages. And you look down here to the results where it's okay. It's a 4% yield, which isn't that sexy. It's a 325 spread. But what's really unique about this bond is its duration. So this bond is a negative 12-year duration. What does that mean? It means if interest rates go up 1%, this bond actually increases in value by 12% in the next year. Now, and what's really occurring, if you match up, you can look, if we look at cash flows on this deal, you have a $246 million balance on the bond. It's paying down on average $2.3 million per month. Basically, you get 1% of your money back every single month. And you own it at 51 cents on the dollar. So you can actually double that. You can double it when you're talking about you know, what your holding period return is. You look at coupon, I won't get into losses here, but my goal when I run this is to really match up prepayments, interest, and implied write-down, you know, how much we're actually losing. My scenario 2, I almost perfectly match up those cash flows, which instead of running it at 10 CPR, I'm running it at about a 15. So you can see here that pop from 10 CPR to 15 increases the value from a 4% yield to about a 5.25. Okay. Now, what else can increase the value? Let's look right here to if we, in this scenario here, 4 and 5, we're increasing interest rates by only 50 or 100 basis points. So by rising rates from 50 by 50 basis points, you go from a 5.25 yield out to about a 7% yield. Okay. Rise rates by 100, you're looking at an 8.5% yielding bond. And if you want to normalize that, if we bought this at, let's say, a 4, and we want to run it at a 4, let's potentially sell it at a 4% yield if and when rates rise, and if and when those prepayments kind of normalize at more like a 15% yield or a 15% CPR. So I'll run this here. We usually do about a half hour here, but I'm almost done with this. So I just wanted to get through. And if you all wanted to follow up to look at more underwriting, we have a number of new investors on the call that wanted to go over some of this with us. And I told them we would do this on this call this month. But we just wanted to go through one bond quick to show kind of how we're looking at these deals. But you can see here, the upside where we own this at 51 handle, prepayments go up, it's worth 55. Interest rates go up, it's all of a sudden worth $60 to $62. So you're talking about an appreciation on this bond of upwards of about 20% over the next year, including earning money, including getting those pay downs over the next year. So let me look at one thing here. And we can do this on Bloomberg quick, where we look at, this is the historical return just over the last year of this deal. Where if we were to buy this a year ago at 51, we own it at 51. It's about a 10% yield over the last 12 months. And so this is a good screen in Bloomberg that we would look at. So I'll plot back here to the PowerPoint and just show, we went over Bloomberg, we went over what we look at on one bond. We're doing this on 100 to 150 bonds per day in Bloomberg. We're interfacing with a couple of exterior databases. We're switching over to Intex to be able to do this and actually run every single bond individually. Which, when I first started doing this 20 years ago, it took me 2 hours per deal. That particular bond I've probably ran 40 times in my life. So now it takes all of about 3 to 4 minutes to just update what's been going on, make sure it's paying correctly. Given that it's one of our largest holdings, all of our holdings, we're updating our assumptions every month. We're running every bond we have through analytics on a monthly basis and picking outliers to potentially trade stuff that is maybe appreciated in value fully. But that's one we particularly like, thus it's our largest holding. Just an update on